Good evening, everyone. This is Warren Buffett, speaking to you directly from my office here in Omaha. Right now, as I sit here during this late November period, we are witnessing what I truly believe is one of the most precarious and dangerous moments in the entire history of modern finance. And let me tell you, I've been observing these markets closely for many decades, through booms and busts, through highs and lows that would make most people's heads spin. The stock market has just seen an absolutely massive erosion in Nvidia's overall value, all within just a handful of recent trading sessions. And this dramatic drop came immediately on the heels of the company announcing what anyone would describe as truly exceptional, record-shattering earnings results. I want you to pause and really let that paradox sink in deep. A company steps up, delivers everything the analysts were hoping for and more, surpassing expectations on every key measure, providing optimistic guidance for the future, and yet, the stock price doesn't soar as it might have in a healthier environment. Instead, it tumbles, and it drags the broader market down right along with it. That kind of reaction, my friends, is far from ordinary. That is a glaring red flag, a warning signal flashing brightly for anyone with eyes to see. Building the context of Nvidia as the market's atlas, expanded with historical parallels. For the past couple of years now, Nvidia has essentially been playing the role of atlas in this entire financial drama, that mythical titan from ancient stories who held the weight of the heavens on his broad shoulders. In much the same way, Nvidia has been the one propping up not just the technology sector, but the broader market as a whole, carrying an outsized burden that no single company should ever have to bear alone. Whenever the market started to wobble or show signs of weakness, investors would point to Nvidia's performance and reassure themselves, saying things like, "Don't worry about the dips, look at what Nvidia is doing." The AI revolution is happening right now, and Nvidia is the undeniable proof of it all. But here's the thing that's been keeping this seasoned investor, someone who's seen more market cycles than most people have had hot dinners, awake during these quiet Omaha nights. A prominent survey of professional fund managers, the folks who handle vast sums of other people's money, has just revealed that concerns over an AI bubble have skyrocketed to the absolute top of their list of potential threats to the markets. This fear isn't just lingering in the background, it's grown substantially sharper in just the recent short period. It's outpacing worries about inflation, recessions, geopolitical tensions, you name it. The overall price-to-earnings ratio for the market as a whole is now stretched dangerously far beyond what history has shown us as a sustainable or reasonable average. And as for Nvidia specifically, even after putting out those truly impressive earnings that beat every expectation, its stock price remains noticeably below its most recent high point. The era of easy rescues, ladies and gentlemen, that party is well and truly over. Nvidia, no matter how strong its business fundamentals might appear on the surface, can no longer single-handedly save this market from itself. And over the course of this extended discussion, which I intend to take my time with, sharing insights slowly and deliberately so you can absorb every bit of wisdom from my many years of experience, I'm going to explain precisely why that is the case. We'll dive deep into the mathematics, the historical patterns, the hidden risks, and the plain common sense that too many seem to have forgotten in the rush of excitement. The timeless Omaha saying, repeated and elaborated for emphasis. You know, back here in Omaha, where I've spent most of my life building businesses and studying investments, we have a very straightforward saying that cuts through all the noise. When you find yourself standing in a deep hole, the smartest move you can make is to simply stop digging. It's not rocket science. It's not some fancy Wall Street jargon. Even someone who's never traded a share in their life can grasp it immediately. But Wall Street, oh, they look at that same hole, they grab an even larger shovel, and they declare with all the confidence in the world, this isn't a hole at all, this is the groundbreaking foundation for tomorrow's innovations. And they dress it up with buzzwords, charts, and projections to make it sound sophisticated. I don't buy it. I call it what it is, plain dangerous, and a recipe for trouble down the road. Let me tell you a little story from my early days to illustrate this point. Back when I was just starting out, buying small companies and learning the ropes, I saw plenty of folks who kept digging deeper into bad ideas, convinced that more effort or more money would turn things around. It rarely did. More often than not, it just made the fall harder when reality caught up. And that's exactly what I'm seeing play out now with this AI frenzy, people doubling down, digging faster, all in the name of progress. Section 1. Mathematical impossibility, expanded, more analogies, slower pacing. Now, let's get into some very basic arithmetic, nothing complicated, no advanced formulas or spreadsheets required. Just the kind of simple math that anyone with a pencil and paper can follow, but that should absolutely terrify every single investor who's been paying even a modicum of attention to what's unfolding. At its most recent peak, Nvidia's overall market value had ballooned to a level that dwarfed the entire economic output of many major countries around the world. Just stop and think about that for a good long while. One solitary company, specializing in making advanced chips, valued higher than the combined productive efforts of entire nations with millions upon millions of workers, factories, and resources. I'm not here to criticize Nvidia as a business. Far from it, they produce genuinely outstanding products, and their leadership under Jensen Huang has been nothing short of remarkable in many ways. But when any company, no matter how innovative, reaches that kind of astronomical size, the basic mathematics of sustaining future growth start to work against it in ways that are impossible to ignore. Even during its strongest recent reporting periods, Nvidia would need to maintain growth paces that simply become unattainable as the company's foundation grows ever larger. It's akin to expecting a fully grown tree to keep doubling in height every season. At some point, the laws of nature, or in this case, the laws of economics and mathematics, step in and say, enough. Let me draw a parallel to some historical examples I've witnessed firsthand. Back in the era of the so-called nifty group of stocks, everyone thought those blue-chip names could grow forever without limits. They traded at premiums that defied gravity, much like what we're seeing today. But eventually, the weight of those expectations became too much, and the corrections were painful for those who ignored the math. The same happened during the internet boom, companies with promising tech but valuations that required flawless execution indefinitely. History doesn't repeat exactly, but it certainly rhymes, and the rhyme here is getting louder by the day. I've been studying these markets for what feels like a lifetime, through countless cycles of euphoria and despair, and I can tell you without hesitation, no single company in the annals of financial history has ever managed to shoulder the burden of an entire market index forever. Not one, not the industrial giants of yesteryear, not the tech darlings of previous booms, none of them. It has absolutely nothing to do with the inherent quality of Nvidia's operations or their innovative spirit. They do indeed craft excellent products that address genuine needs in the world. It's purely a matter of simple, unyielding mathematics. The burden, the expectations, the sheer weight of it all, it eventually becomes far too heavy for any one entity to carry alone. And consider this current situation unfolding right before our eyes. Nvidia steps forward with earnings that demolish every analyst prediction across the board, data center revenues climbing impressively, future guidance exceeding what Wall Street had anticipated. In a truly rational, balanced market environment, news like that should propel the stock upward in a significant way, sparking celebrations and buying sprees. Instead, what do we see? The stock price drops sharply. The major indexes follow suit, stumbling noticeably. Why on earth would that happen? Because, at long last, the market is beginning to ask the crucial question that should have been front and center all along. Just how much anticipated future growth is already baked into these current prices? And the honest answer, based on everything I've seen, is, way too much. Far more than what prudence would allow. We're witnessing the collision of peak-level valuations with equally peak-level expectations, and when those two forces meet head-on, the results are rarely pretty. It's like building a towering structure on a foundation that's not as solid as it appears. Eventually, cracks form, and the whole thing starts to sway. Expanding on concentration risk, more historical depth. This market rally that we've all been experiencing isn't a broad, inclusive kind of advance that signals genuine, widespread economic health. No, it's one of the narrowest, most concentrated rallies I've ever observed in all my years. Just a small handful of stocks, that group often referred to as the magnificent ones, have been responsible for the lion's share of the gains in the major indexes. If you strip away the performance of those few standout names, the rest of the market has scarcely moved at all over an extended period. That, my friends, is not a sign of underlying strength. It's a dangerous illusion, a mirage that can vanish when conditions change. To put it in terms that anyone can visualize, it's like claiming the average temperature in a large room is perfectly comfortable, when in reality, one small section is blazing hot like a furnace, while the vast majority of the space is chilly or even freezing. Sure, the mathematical average might come out looking fine on paper, but the actual experience for most people in that room would be anything but comfortable. The reality beneath the surface is fraught with risk and imbalance. Let me take a moment to reflect on why this kind of concentration is so problematic. In my early investing days, I learned the hard way that putting too many eggs in one basket, or in this case, relying on too few companies to drive all the returns, sets you up for severe disappointment when those few falter. Diversification isn't just a buzzword, it's a fundamental principle that has protected investors through thick and thin. When the market becomes this lopsided, it's like a house built on stilts over uneven ground, stable for a while, perhaps, but vulnerable to the slightest shift. Section 2. The circular financing, expanded, detailed storytelling, multiple examples. Now, here's an aspect of this whole situation that should make every thoughtful, serious investor pause and feel a deep sense of discomfort. I call it the Great AI Financing Circle, and let me assure you, it bears some truly disturbing resemblances to financial schemes I've watched unravel spectacularly not once, but twice before during my long career, first in the late period of conglomerates, and again amid the frenzy of the dot-com era. I want you to visualize this circle as a tight-knit group of perhaps a dozen or so major players in the tech and AI space, names like Nvidia, Microsoft, OpenAI, Meta, Alphabet, Amazon, Oracle, and a few key infrastructure providers. The money flows in a loop that's almost elegant in its simplicity, but treacherous in its implications. It starts with Nvidia investing substantial amounts directly into companies like OpenAI. Then, OpenAI turns right around and commits to purchasing vast quantities of Nvidia's chips over extended periods. Microsoft enters the picture by pouring resources into OpenAI, while simultaneously acquiring massive volumes of Nvidia chips for its own expansive data centers. But it doesn't stop there. Microsoft also invests in other specialized infrastructure firms that, in turn, provide computing power back to OpenAI, using, you guessed it, Nvidia chips. And to close the loop, Nvidia holds equity positions in many of these very same companies that are buying and utilizing its products. Do you see the circular nature of it all? Resources flow out from one entity, only to boomerang back through purchases and partnerships, all within this relatively closed ecosystem. On the surface, it appears as explosive, organic demand, record sales, booming revenues. But peel back the layers, and much of it is the same pool of capital circulating endlessly, being counted as fresh growth at each stop along the way. I've seen this pattern before, and it never ends well. During the conglomerate craze, companies would acquire others using inflated stock, creating the illusion of endless expansion. It looked brilliant until the synergies failed to materialize, and the house of cards collapsed. Similarly, in the dot-com days, firms would extend credit or even lend money to their own customers to fuel purchases of their products, booking it all as legitimate revenue. It was vendor financing on a grand scale, and when the underlying demand proved illusory, the evaporations were swift and devastating. A well-known investor, famous from stories like The Big Short, recently highlighted this very issue, noting that true, independent end-user demand appears minuscule compared to the hype. Most of these so-called customers are being funded, directly or indirectly, by the very companies they're buying from. We used to label that as vendor financing back in my day, and it was always, without fail, a massive red flag waving in the wind. To be absolutely clear, I'm not accusing anyone of outright illegal activity here. These kinds of arrangements occur in various industries, particularly during rapid build-outs of new infrastructure. But the sheer scale we're witnessing today, vast sums swirling within such a confined group, is unlike anything I've encountered before, and it raises profound questions about sustainability. What happens when this delicate circle inevitably breaks? And trust me, based on history, it always breaks eventually. Perhaps one key player in the chain starts to scrutinize their returns on these massive AI investments more closely. They realize that all the spending on data centers and chips isn't translating into the revenue growth they promised to their own shareholders. So, they decide to trim back their next round of capital expenditures. That reduction ripples through to Nvidia's upcoming results. Nvidia's stock takes a hit. Then, the other companies in the loop, who hold Nvidia shares or rely on its ecosystem, see their own balance sheets weaken. They cut spending even further to compensate. What was once a virtuous upward circle transforms into a vicious downward spiral, accelerating with each turn. We're already spotting the initial fissures in this structure. Prominent AI firms, despite all the hype and sky-high valuations, are still hemorrhaging cash at alarming rates. Their projected revenues look promising on paper, but they're locked into enormous commitments for computing power that far outstrip what they're bringing in. That's not the hallmark of a sustainable business model. That's a high-stakes gamble, burning through resources in the hope that the economics will somehow flip in their favor down the line. Reports on deals between these players are particularly revealing. Major cloud providers announce massive partnerships with AI startups, and their stocks surge on the news. But dig into the details, and you find that the actual financials of these arrangements are unprofitable for the providers involved. They're incurring substantial losses to secure these deals, all in the name of positioning for the future. Folks, that's not sound investing. That's speculation dressed up in business attire, and I've seen too many such costumes unravel over the years. My late partner Charlie Munger had a favorite saying that cuts right to the heart of this: show me the incentive, and I'll show you the outcome. Right now, every major tech executive is under immense pressure to prove they're not falling behind in the AI race. They step onto earnings calls and proudly tout their escalating AI expenditures as evidence of forward-thinking vision. Wall Street rewards those announcements with higher stock prices, creating a feedback loop that encourages even more spending. But amid all this enthusiasm, too few are asking the tough, essential question: when, exactly, does all this outlay start generating real, tangible returns for shareholders? I've lived through enough market cycles to spot when the connection between prices and fundamental business value starts to fray. In one era, certain elite stocks traded at any price imaginable because endless growth was taken as a given. In another, fledgling internet firms with no profits whatsoever commanded enormous valuations based solely on potential eyeballs and market share. The details evolve with each cycle, but the underlying pattern remains constant. Prices detach from reality, complex financial webs replace simple profitability, and everyone justifies the extremes by pointing to what everyone else is doing. That's precisely when the wise investor begins quietly looking for the nearest exit. To be fair and balanced, as I always strive to be, AI represents a genuinely transformative technology with the potential to reshape our world in profound ways. In a couple of decades or more, we'll likely look back and recognize how artificial intelligence altered industries, improved efficiencies, and solved problems we didn't even know we had, much like the internet did after its own turbulent beginnings. But acknowledging the technology's promise doesn't mean endorsing current prices as justified. Nor does it imply that every company throwing vast resources into AI infrastructure will emerge victorious from the shakeout. The internet bubble taught us a vital lesson that bears repeating: being correct about the technology's eventual impact doesn't guarantee profits as an investor. One famous online retailer from that era correctly predicted that people would buy pet supplies over the web someday. They were spot on about the trend, but disastrously early in timing and priced as if the future had already fully arrived. Another survivor from that period endured because its founder raised sufficient capital to weather the storm and build a truly sustainable model beneath the growth narrative. Most others weren't so fortunate. Today's AI landscape feels eerily parallel. The tech is real, the possibilities immense, but the economics are still murky, and valuations presume a flawless rollout of a future that may unfold much more gradually than prices currently suggest. What truly concerns me about this financing circle is how it distorts the reliability of earnings reports as true indicators of organic, end-user demand. When customers are largely propped up by the same entities they've partnered with, and payments cycle back using funds that originated from the seller in the first place, you're not witnessing natural market forces at play. You're observing a meticulously choreographed performance that dazzles as long as all participants keep in step. But eventually, the music fades, the dance ends. The question isn't whether it will happen, but when, and what devastation follows when investors realize that so much reported revenue was merely capital sloshing in circles rather than genuine growth. Section 3. A market without its hero, expanded with more patterns and warnings. Let me share a pattern I've observed repeatedly over the course of my extensive investing journey. Markets always crave a hero, a compelling company, a hot sector, an irresistible narrative that rationalizes climbing prices and calms jittery nerves. In one past era, it was a select group of supposedly unbreakable blue-chip stocks. In another, it was any venture tied to the emerging internet that promised to revolutionize everything. Later still, it was the housing market and complex securities backed by mortgages, with the mantra that property values only ever rise. Each time, investors convinced themselves they'd discovered something that defied the usual rules of gravity. Today, Nvidia has filled that heroic role for the recent period. Whenever uncertainty crept in or the market teetered, people could always point to Nvidia's remarkable trajectory and declare, "Look there, the AI transformation is authentic, and as long as Nvidia keeps delivering, we've got a solid base under our feet." But history has taught me, time and again, that when a market grows overly reliant on one company or a narrow cluster to sustain its upward momentum, trouble is already brewing beneath the surface. The recent events tell a compelling story. Nvidia announces those outstanding earnings, with revenues climbing impressively and outlook remaining strong. The company checks every box. Yet, the stock declines noticeably, pulling the tech-heavy indexes down with it, along with the broader market gauges. This disconnect reveals everything you need to know about our current cycle stage. Solid news no longer suffices. Even exceptional news fails to ignite the spark it once did, because the market has awakened to what value-oriented investors like myself have emphasized all along. At a certain threshold, price overrides growth in importance. Volatility measures are spiking, sentiment indicators have plunged into fear zones. These aren't hallmarks of a robust market on firm ground. They're symptoms of an overextended system groping for balance without finding it. Section 4. The 3 stages of every bubble. Slow, narrative style with extensions. Having navigated every significant bubble of the past many decades, I can outline their progression like a familiar play in 3 acts. Act 1. The denial phase. Here, warning signs emerge, but investors brush them aside with convictions like, "This time is truly different." They highlight real technological breakthroughs, and AI certainly qualifies as revolutionary, to defend valuations that no mathematics can support. Traditional metrics are dismissed as outdated for these transformative entities. I've heard these very arguments echoed in previous booms about emerging tech. Act 2. The confidence crack. It often begins modestly, a single underwhelming report, unexpected news, or shift in conditions. Perhaps a leading tech firm admits its AI outlays aren't yielding expected returns. Maybe one of those circular arrangements phrase. Or external factors make current prices appear even more untenable. The trigger varies, but once confidence fractures, it propagates rapidly, like a crack in glass. Act 3. The great repricing. This is where things turn truly chaotic. Investors collectively recognize they've overpaid, rushing for exits simultaneously. Yesterday's darlings become today's outcasts. Seemingly invincible firms trade at mere shadows of their peaks. The broader market, dependent on those few stars for its facade of health, finds itself exposed with no shelter. We've moved beyond the first act, folks. The second is well underway, with cracks visible to the observant eye. Final extended straight talk, deliberate, wisdom-filled close. Let me wrap this up with the straightforward, no-nonsense talk I've delivered to Berkshire shareholders for what seems like forever. There's an old truth. A pin awaits every bubble, and their meeting teaches fresh generations ancient lessons. We're nearing that juncture now. Nvidia stands as a remarkable company with top-tier products and stellar leadership. My respect for Jensen Huang's achievements is immense. But greatness doesn't grant immunity from valuation mathematics. Current prices demand unerring perfection far into the future, a rarity in business. The market prices in flawlessness from Nvidia and its circle. Such assumptions breed disappointment. When it arrives, not if, but when, those who overpaid for speculation will face costly reckonings. My timeless advice: grasp what you own deeply. Heed the price paid. Build in safety margins. Avoid following crowds blindly. As of long written, wise actions at the start become foolish at the end. We're deep in that end phase for AI speculation. No company can justify such extended valuations across a whole index forever. The math forbids it, history confirms it, signs abound for the willing. The peril lies in, this time is different. It's never so. Details shift, but psychology and math endure. Warning of overpayment, overhope, overreliance on miracles. In past crises, when fear reigned, I advocated buying when value exceeded price. Today, it's reversed. Prices dwarf reasonable value. Timing markets as futile, but valuing them as possible with patience. Focus on comprehensible businesses. Shun miracle requiring prices. Diversify adequately. Compound wealth across long horizons, not chase short-term momentum. Speculation may linger beyond reason, but gravity prevails. Stay safe. Remember, better to skip gains than join losses. This is Warren Buffett from Omaha, thanking you for your time.